Hey, what's up? Today I wanted to go over Pendle, how you can use it to fix yield, to provide liquidity, to earn or speculate on airdrops. Pendle is great for all of that, or if you're just looking to trade yield, you could use Pendle as well. So one of the biggest use case for Pendle is to earn a fixed yield on an asset. If you guys have been interacting with different DeFi protocols like Athena or Aave, you would know that the interest rate that you would be earning is not going to be constant, right? But with a platform like Pendle, we could choose to fix our rates if the rates are attractive enough. And the rates could be different in different markets as well, right? If we go on the Hyperliquid, for example, and we're looking at the USDE yield, the yield is slightly higher than the other markets. So we could be taking advantage of that opportunity if we decide to lock in some yield or if we're buying YT to hopefully get some airdrop points. And that is also another way that we could be using Pendle. And if you're new here, my name is Richard. I'm a DeFi investor and a yield farmer, and I mostly work with concentrated liquidity pools, but I do use Pendle from time to time. I haven't been a very heavy user of Pendle, but I did spend the time to look at all of the documentation and go over like the pros and cons for using Pendle. So I'll break down exactly that in this video. And I also recently ran this workshop in the Drippy community. Unfortunately, when I was recording, I didn't record the audio for the mic. So I'm remaking this video. Hopefully it helps explain how to use Pendle if you guys missed the workshop. So to quickly explain Pendle, I think a most simple way is to actually do it with an example. Let's say you're lending out $100 on a platform like Aave, right? So you're lending it out and maybe the interest rate is 5% and you're planning to lend it out for a year, so 365 days. And at the end of 1 year, you would have about $105, assuming that the interest rate go up and down between that 5%, right? So roughly 105 by the end of the year. But let's say you're depositing into Aave, you're using USDC. What you're going to get in return is a USDC, right? And that kind of denominates how much you've deposited into Aave. Just to make the number simple, let's just call it 100 AUSDC. And then after 1 year, you could redeem it for 105 USDC after a year, right? But what Pendle basically does is it splits this AUSDC into the yield token and then the PT, which is the principal token. So the easy way to understand YT and PT is that the YT entitles you to the underlying yield and the airdrop points of the underlying protocol. So let's say the YT would be worth $5 in the very beginning when you first buy into this token. And then the PT would be worth $95, right? Because you're turning $100 and then splitting it into two. You can't just create money out of thin air, right? So this is what Pendle typically calls the SY. It's the underlying yield token, and it's equivalent to if you just deposit it onto Aave. If you just buy the YT separately, you're entitled to that 5% yield. And let's just say you spend $5 to buy this $5 YT. After 1 year, assuming the interest rate stays around 5%, you would earn $5 in return, right? And then after 1 year, this $95 PT becomes $100 in USDC. So that's how the PT and the YT works. The principal token gives you back the principal amount, which in this case is $100 USDC when it reaches maturity, right? So that's the important part. You will be able to redeem for the maximum amount at maturity, assuming the underlying asset does not depeg and the protocol is secure. And this is how you earn a fixed yield, right? Because the yield for the YT would fluctuate while the PT yield stays the same. So in this scenario, it's the same as if you were just lending out in Aave, but let's just say interest rate goes up to 10%, right? What would this scenario become? You would earn $10 from this YT instead of the $5. And if you just spent $5 to buy the YT, you would earn $5 extra, right? So that's 100% extra ROI on your investment if you were just buying the YT and the interest rate rises. So this is how yield traders could trade yields. When the yields are really low and they expect the yield to go up, they would buy YT. Or if they're speculating on a particular airdrop, they would buy this YT to get the points for the airdrop, right? And it could be worth it or not, depending on how expensive the YT is and how much the protocol actually airdrops you when the time comes. And for the PT, in this second scenario, you will still have this 100 USDC at the end towards the maturity. So the total net yield is $110, right? 10% on initial investment. But with the PT, you actually earn only about 5 something percent simply because you decided to fix the yield, right? So knowing that when is the best time to fix yield is to actually when the yield is high, you see a lot of cheap PT. You could buy a bunch of PT at a discount and then towards maturity, that's how you earn all of this money, right? And the best time to buy YT is if you expect the yield to rise into maturity rather than decline. So if you're speculating on yield, you could be buying YT instead of just locking your PT. And before I move on here, I want to show you the opposite scenario of let's just say the yield drops to 2%, right? So instead of earning $5 on your initial investment, now you would earn only $2 at the end. So you would lose $3 in this scenario if you spent $5 on the YT. That's more than a 50% loss, right? So buying YT is always riskier, even though it gives you a larger potential upside. And if you buy them together, you're basically just lending out your money in Avid, right? And I'll show you guys how you could actually earn a little bit more through providing liquidity through Pendle by actually getting exposure to all of these assets. But in this scenario, because you fix your yield, again, this PT would mature to $100 USDC at maturity. So in this scenario, if the yields do drop, let's say there's a bear market, a lot of people were not really borrowing stable coins, they're not using leverage, then the yield would drop, but then you actually did better than like the YT buyers or people that straight up just lended out the USDC, right? So before I talk about providing liquidity, we could see a few examples of that. You can look at like Hyperbeat USDT, for example, and you can see the current PT is trading at like roughly 15 or 16% APY, right? So if I were to deposit, let's say 1,000 USDT into this PT, if I'm trying to buy some PT, right? What you're going to see is that the effective APY, this is the return that I would expect to get at maturity. This basically factors in the fee and the price impact when I'm buying into this token. And just like any liquidity pool, if you buy too much of the token, you would have a large price impact, right? And then the APY would drop from like 15 something percent to 13% if I were to deposit $1 million into this vault. But that's still a really good fixed yield if you believe that the underlying protocol is safe. Obviously, in general, you don't want to just put your whole portfolio into like one protocol. So you wouldn't really be putting like $1 million here, even if you had $1 million, right? But you can see depositing $10,000 into this PT Hyperbeat USDT here is going to allow me to gain about 10,253 worth of this PT Hyperbeat USDT, right? And what I highly recommend is reading the details here. You don't want to skip over this. This is what they tell you about like each of the market, how they're earning their yield, and the risk associated with it. And you want to look into the particular protocol as well, right? If you go into Hyperbeat here, what you're going to notice is that they're actually earning yield on different hyperliquid markets, right? So they could be depositing into different protocols like the Felix protocol, or they're yield farming the stable pairs in the Hyperswap protocol. They're depositing a little bit into Pendle, right, into Spectra, and you can see their current positions right now and their historical APY. And the reason why the APY spiked pretty recently is because of the liquidation event. I believe that the Hyperbeat vault has exposure to the HLP, which is the Hyperliquid liquidity provider vault. And when there's large liquidations in the market, that's how you can make a lot of money in the process. But again, it's not going to be guaranteed future return, right? We just had a huge spike in the APY. Maybe it would go up, maybe it would go down. If there's more liquidation, we could probably expect more APY from this underlying asset. If there's less liquidation, then the APY would drop. And you guys can look at the charts as well. Typically, if there's a huge spike, on the underlying APY, like what we saw here in October 13th, is typically not going to sustain over time, right? But again, you can lock in the yield at any time. The spike is not really going to actually impact the implied APY by that much. And which leads me to my next point. So how does the YT and the PT yield gets determined? What we have to actually understand is that SY, let's just call it like $100, would equal to YT plus PT, right? So let's call the YT $5 and then the PT $95. So what happens in the market is if people believe that the YT is going to give them more than the 5% yield that you would be buying with this YT token, right? Assuming again 1 year maturity, they're going to be buying YT. If you buy an asset, the price increases, right? And so then maybe the $5 would go to $10. And because this whole amount equals to one SY at $100, then the PT price would drop to $90, right? So this is how it works. If people are buying YT, it drives up the fixed yield because now you could buy $100 at a discount for $90. And again, if people keep buying YT, the worse it is for you to buy YT simply because the yields tend to drop and normalize after a while. So if the YT drops, for example, to like $2, right? Because people are maybe selling a bunch of YTs because they believe that the yield is going to drop, or they're buying a bunch of PT, which would drive up the price of PT to like $98, for example, then the YT price would drop, right? So it's always like a balance between the YT and PT. The price is inversely correlated. So this is what you have to understand when buying the YT and PT. Again, the lower the PT price, assuming the underlying asset is safe and the protocol is safe, the better it is to fix your yield. And another mechanic that we have to understand with YT and PT is that the yield token over time would decline in value, right? It's going to go from $5 to $0, the YT token itself. The reason why is because as it declines, you're getting yield in the process, right? You're getting $5 in yield. Assuming the APR stays at 5%, in reality, it's probably variable, right? Let's just say the APR goes between like, 2 to 10%. Then at the end of 1 year, you're going to get this whatever amount that the APR is. But throughout the whole process, your PT is going to rise to $100 when it's actually close to maturity, right? So 95 is slowly going to rise to $100. So this is how the YT and PT works. And again, when you pair them together, it equals to the underlying yield tokens, right? And the reason why these values fluctuate is because there's a maturity date. And that's how you could actually earn a fixed yield and redeem for the underlying asset when the maturity is up. So we can look at this particular Hyper-B vault here and look at the price. So if you guys go to the APY tab on the charts, you could click on price and zoom out. What we're going to see again is the PT price going closer and closer to $1, right? So you're buying $1 at a discount here. Back here, you're buying $1 for 0.95. And then after a while, you're going to earn a yield in the process and you're going to be able to earn a full dollar over time. Again, when there's like a huge drop in price, that's the best time to be depositing. If we look at the APY here, what you will notice back here is when the APY spike, that's when the PT price is lower, right? And most likely it's because people are either selling their PT or a lot of people are buying YT in the process. It's most likely people buying the YT because buying a bunch of YT could impact the price by quite a lot. The reason why is because if you just buy $5 worth of YT, it actually accounts for the yield of the $100 Aave USDC in this case, right? So you could buy, let's say $500 worth of YT, but you're actually entitled to 100 YTs. If you're actually multiplying that by $100, which is this amount here, right? In the beginning, your total exposure is actually the yield of $10,000 in total, right? So you're getting the yield of this $10,000 in capital. If the yield is less, of course, you will lose this $500 investment. If it's only like 2 to 3%, maybe you'll get like $200 to $300 back, right? But if the yield is like 9 to 10%, then you would get like 900 to $1,000 back. So that's why like buying a bunch of YT would have a big price impact. So if I buy $10,000 worth of YT, you can see that the impact on the APY would change by quite a lot compared to if I buy $10,000 worth of PT. The yield does change, but not by a lot. If you're happy with this yield, about like 15%, then of course you could lock into this protocol. And again, we want to do research on the underlying protocol. If you're comfortable with Hyperbeat and their underlying strategy, I believe it is a more actively managed vault. So you have to keep that in mind. There's always risk associated with higher yield products. So we got to keep that in mind. But again, if you want to lock in the yield, it's 15 to 16% right now. And you can look at the conversion rate here, how you deposit, how you withdraw. And you want to actually double check the details for every single market because it's going to be different. In this case, if you buy the PT Hyperbeat USDT, you can withdraw directly on Hyperbeat if you click this link here, right? And what we will notice if you dive deeper into the Hyperbeat vault is that there's actually a 3 days waiting time for you guys to withdraw if you're trying to get your capital out of Hyperbeat. And there's a 0.5% early withdrawal fee if you need the money right now. So that's something to consider. You don't want to deposit into this vault if you have to withdraw right away, right? And you could read why the withdrawal takes 3 working days. A lot of these on-chain strategies do need time to unwind safely. That's why it takes time to actually withdraw. And again, you have to do research on the underlying protocol. I'm not endorsing Hyperbeat, and none of this is meant to be financial advice. I'm just showing you guys how Pendle works and that you guys could incorporate it into your DeFi portfolio if you choose to. And it also tells you the risk, right? This pool would generate negative yield if allocation to DeFi strategies from the vault is unprofitable. So theoretically, you could lose money if the Hyperbeat vault loses money over time. Even if you locked in your yield, you might not be able to redeem for the one full USDT. If their yield is actually not sustainable, they earn negative yield over time after you lock. So that's something to watch out for as well. And again, the YT, you will earn the underlying yield. If the yield spike, like what we saw in the last couple of days, a ton of people made money from the YT, right? But that's more of a black swan event. I don't think there's going to be like huge liquidation event, like one after another, right? So in this yield, you could expect it to drop a lot. But what you will notice is that by holding the YT, you would earn a lot of points from these protocols as well. So if you're trying to earn an airdrop, then buying some YT could be good when it's cheap, or you could be looking at providing liquidity to get exposure to both. So let's look at that now. If we go to the liquidity section, what we will see is that you could scroll down. And again, you want to read all of those details, right? And what you will see is that where the yield is exactly coming from. The first one is the underlying asset. Again, the SY is equivalent to like the Hyperbeat USDT that is in the vault, right? So roughly 64, 65% of this liquidity pool is going to be earning the underlying yield, the same exact amount that if you were to deposit on the Hyperbeat platform, the same exact yield that you would be earning, right? But because the liquidity pool requires the PT to be here, the rest of the amount, in this case, is roughly 35, 36%. You're going to be earning a fixed yield, right? It's about 5.6% of the overall capital if you actually work out the numbers, but your combined yield would be higher than just 5%, right? Let's say the SY is earning about 10% on your total liquidity pool capital, and then the PT yield is earning 5%, then added together is around 15 something percent. And then what you will also earn in addition to just the PT or the YT is you will earn some swap fees. If people are swapping in and out of this pool a lot, then you'll earn a ton of swap fees, right? In this case, it has been about 7 something percent. I believe it's a huge spike because of the recent liquidation event. You guys can check the chart here. You can see the increasing liquidity from like 8 million to about 10 million here. And just like any liquidity pools, right? The more liquidity, the less APR you will generate, assuming the volume stays the same. But if we zoom out back here, the liquidity was even higher. And what we could also see is the pool fees tab and kind of zoom out here and kind of get a gauge and estimate on the fees, right? So you could see the fees have been relatively low for like these couple of months in like September, but then there was a huge spike here in the liquidation event. But again, that's kind of a one-off event. So if that's factored into that 7% yield that we were just looking at, maybe the fee APY for this pool is not going to be accurate. So that's something to consider when you guys are providing liquidity. And again, when you guys provide liquidity, you can swap from any other asset. You could put like a lot of money into it or very little money into it. Let's say you put in 100K, right? And it tells you the expected outcome here. But let's just say that we want to actually calculate like the rough APY we could expect from providing liquidity for this pool. What we could do is we could figure out the fees, right? What is a reasonable amount of fees that we could be earning? If you're expecting a couple $100, maybe let's just say like $500 a day, we could analyze that, right? $500 a day over 365 days. That's about $182,000. And if we were looking at the total liquidity, it kind of hovers around 10 million, right? So if I take that number divided by 10 million with a more conservative estimate, you could gain an additional roughly almost 2% APR by simply providing liquidity into this pool instead of buying PT or the YT. Again, it depends on what you are trying to do. If you're trying to just get a fixed yield, then you could, of course, just buy the PT. But if you want the exposure to the Hyperbeat Vol as well, then providing liquidity could be a great way to do so. And what you will also notice is that they're actually having like a points program, like the 2.5 million hearts, that is actually allocated to these pools, right? So if you're actually providing liquidity here, you're going to earn some airdrop points, and you can read more about the announcement here. And before I move on, this pool also would earn you about 3 something percent in additional Pendle incentives. So if you total up about 3% plus this about 1.8%, so it's about like 4.8% of extra APR. And if you estimate the underlying APR and the fixed yield portion of the pool to be around 15%, you could be looking at about 20% on your capital. And again, by providing liquidity, you are taking on the smart contract risk for Pendle, and you are taking on the risk of the Hyperbeat Vault, and you are actually exposed to the HBUSDT underlying asset, right? So there is risk involved. But again, if you're comfortable with taking that risk, then you could be depositing into this vault. And before I hop off here, I want to kind of explain how the liquidity pool works. The liquidity pool is basically made up of the SY plus PT, right? And the way it works is that when you're adding new capital to the LP, you're actually getting this SY token, and then you're actually splitting it to SY plus PT plus YT, right? And the ratio would depend on the value inside the pool. Currently, right now, it's like mostly SY, right? Like 64, 65%. So then let's say it's like 2/3, right? And then 1/3 is in this PT and YT token. And then normally, if you don't switch on like this tab here to keep the YT, what Pendle does, it automatically sells this YT for more PT. So they will sell your YT for PT. So then inside the pool, if you don't take it on, you would actually have a little bit more fixed yield compared to taking that option on, right? So when you actually do that, it actually goes to this finally, right? So this is the final exposure you have. You have about 66% currently in the underlying asset, which is the Hyperbeat USDT. And then the rest, 1/3 is in the PT token. So it's a little bit more of a fixed yield, roughly 1/3 fixed yield, and then 2/3 variable yield. But what is really cool is that you could also tick on this to keep the YT mode. And what this is going to do is instead of selling the YT here, what it's actually doing is that you actually get to keep this whole amount, right? When you provide liquidity, you will be getting the LP token, which actually accounts for like this portion of the equation, right? Let me move this down a little bit, but you'll also get to keep the YT. So if you take that on, that's also another option. And this would actually be equivalent to simply depositing on the Hyper-V vault. But the reason why you provide liquidity, there's a couple reasons. The first is you're going to get that swap fee, right? The more people swap, the higher the APR is going to go. And you're also getting Pendle incentives, about 3 something percent extra. So it's actually a better deal to be providing liquidity here rather than directly on Hyper-V. And in my opinion, the best way to actually get a hang of any new protocol is to actually play with it. You guys can see on my demo wallet, I bought some PT, I bought some YT, and then I also provided liquidity in the process. And you guys can start off with like $100 or a couple $100, see how it goes, right? See how you like using Pendle. And again, I'm just using this for demo purposes. I currently don't hold like an insane amount of stable coins. So I'm just parking mine on Aave. But when I have more stablecoin allocation, I would also be using more Pendle as well. So that's the main way on how you can use Pendle. And there are other things you can do with Pendle as well. For example, you could be locking Pendle. And by locking, you're actually locking the token for 2 years. And then you could vote to incentivize different pools and earn some APR in the process, right? If you click on vote, you'll be able to vote on different pools. And then it also estimates like the projected voter APR, where you could be earning like the USDT that comes with like the trading fees when people are buying and selling YTs or providing liquidity. It's going to go to these vPendle holders, right? And one thing about locking is that it could take some time for you to actually unlock. So let's say you want to lock like 1,000 Pendle. The max lock is 2 years, and you're going to receive more vPendle the longer you lock, which allows you to earn a higher yield, right? But the problem is you got to wait for the unlock to be able to sell your vPendle. And there are other options like the Magpie M Pendle as well, and like the Equilibria Pendle if you want to be converting your Pendle into vPendle. So those are like the liquid wrapper protocol that you guys could look into. But for most people, if you don't want to lock your tokens because maybe you want to take some profits if the prices go up, then we definitely don't want to go for this option, right? I personally like to provide concentrated liquidity. I like to provide for different pools like Pendle to ETH. Pendle right now is on like a downtrend, like a lot of different altcoins. If it gets cheap enough, I'll probably pick up some spot Pendle or maybe provide liquidity for Pendle to USDT. I'm currently yield farming Pendle to ETH. Currently, it's sitting at the bottom of the range because the altcoin market has been quite weak. But we'll see if it swings back up or not. If not, I'll just stay tight and just hold on to my Pendle. That's kind of how I'm managing my position. But basically, that's the big overview on Pendle. I hope that was helpful, guys. It's a little bit harder to understand, but the main thing that we need to understand is that the YT gives you the underlying yield and the airdrop points. The PT is fixing the yield, right? You're going to be able to redeem for the full amount when the maturity comes. And then the liquidity pool is made up of the underlying asset plus the PT. And one thing I forgot to mention as well is over time, as the PT gets to maturity, your PT is going to be slowly converted to the SY, which is the underlying token, right? In this case, it's the Hyper-V USDT. And then at maturity, you'll be able to claim back your USDT. So I hope that was helpful and kind of like a big overview on how to use Pendle. There's a lot of other things you can do with Pendle, like you could use the PT token to leverage up or to use as collateral in different DeFi protocols like Aave. Usually that is riskier and not a great idea to do if you don't know exactly what you're doing. And even if you do, you don't want to be over leveraging and leveraging your entire portfolio, right? If you want to check out more videos on DeFi and investing, be sure to check out the other videos on my channel. And if you guys want to connect with other DeFi investors or attend the live workshops, then be sure to check out our Drippy DeFi community. The link is in the description. Again, if not, there's a ton of free videos on my YouTube channel. Thank you once again for watching. I'll catch you next time.